Hello and welcome to today's webinar, Building an Alpha-Seeking Portfolio, Asset Allocation and Risk Management, hosted by Index One in collaboration with BX, Artha, Libra Investment Services, and Trendrating. I'm Gayatri from Index One, your host for today. We're thrilled to introduce our speakers. Alexander Berg, founder and CEO of Index One, Chris McHeffey, President of BX Partners, Justin Lowry, President and Chief Investment Officer of Artha, Chris Tinker, Founding Partner of Libra Investment Services, and John Coulter, Managing Director at Trendrating. In today's session, we will explore techniques for identifying alpha opportunities, the impact of market conditions on alpha strategies, building trend capture strategies, and creating your own alpha-seeking asset allocation strategy. We'll also have a demo of Alpha's platform to show how you can build your own alpha-seeking strategy. We'll have time for questions after the presentation, so please submit your questions in the chat box as they come up. Now, without further delay, let's dive in. Chris McHeffey, could you start by explaining what an alpha-seeking strategy is and some techniques for identifying alpha opportunities?
Yeah, thanks, G. Simply put, alpha is the ability to generate excess risk-adjusted returns in a portfolio. And really, it's the reason BX exists, is to equip advisors with the ability to deliver better risk-adjusted returns for their clients. So why would that be so important? Well, if you look, the 3-year trailing return on a portfolio as of today, it was 60% the Russell 3000 and 40% the aggregate, returned 1.3% annually. That's not getting anybody to their goals. It doesn't matter how great your tracking error is, 1.3% is just not good enough, and clients are looking for something better. So at BX, we scour the earth to find strategists that we believe have the ability to deliver alpha or better returns in portfolios over time. So we have a number of different techniques for generating alpha, all of which have significant value. So we have 3 of our portfolio creators on with us today to talk about what it is that they do specifically to help generate alpha. So first up, Chris Tinker from Libra Investment Services, take us through your process.
Thank you, Chris. Appreciate the opportunity to not only talk to the audience here, but also reinforce the fact that working with BX Partners is exactly what we feel as idea creators is the right way to give dynamic ideas through to end users in a format that suits both the end user and the creator. So it's a very good feedback environment to be working in. And that's one of the things I would like to emphasize, is that the philosophy and approach that we have is you've got to do 2 things. Obviously, we all can look, we're just in equities. We're not a fixed income part of the universe, although obviously portfolio construction on a broader basis includes other asset classes. We like to really focus in on the equity side. And so if I can just go to the first slide, G, from here. Thank you. Ultimately, when we're producing alpha ideas, we're looking at stocks. We're looking at stocks that not only have a return that we can quantify and measure. We have our own models that build and design our ability to forecast stock returns on a daily basis, updating over lots of different time horizons. But everything is really about expected return. What are we expecting anything to pay off for us? And so the process that we follow is to say, let's not just look at the return that's available, but let's understand how we're managing the risk simultaneously with that. Because obviously, the kind of return that you're going to get from owning NVIDIA is a very different kind of return you're going to get from owning General Motors. And sometimes it's useful to have that return and just lock it away in your portfolio and then come back 6 months or 12 months later. But we feel if you're going to build a portfolio, every time you build a portfolio should be, sorry, is that somebody speaking? Sorry, there's sound in the background. I don't know if somebody was speaking. But essentially what we do is we recognize that we all talk about alpha, but there's always a measure of beta. In other words, what's the market expecting from a company, and is there a way that if the market is expecting a particular return from a stock, we can identify which stocks actually have a higher or lower degree of risk in relation to that, and therefore we could have a stock that looks good on paper, but in reality is far too expensive in the short term or far too cheap in the short term. And that's really what we're trying to pick up. We're trying to identify where, out of a large universe of stocks, any universe of stocks, we can find those extra value added. So if I can just go to the next slide, G, please. So we have a number of models, one of which is to create a value measure. We create a value measure for every stock every day, and that adjusts all the time. But we also have three other models. One is the risk model. The second is an expected return model. And then we have a factor approach as well. So in summary, what we're doing is we're saying, let's look at the stock and let's look at all the elements of both what's going to give us a return and also what the risks associated with that stock is. And it's not just about whether Apple is a technology stock. It says, is Apple trading as a growth stock at the moment, or is it looking more like a quality stock? So we have all of our own measures for that. And by adjusting and re-estimating what each stock is on a regular basis, we can then build portfolios where we can either be very factor focused, so we can build you a value portfolio, or we can build you a combination of value and quality and growth, or whatever combination you want to put together. And that flexibility means we have our own portfolio recommendations on BX, but equally, if you want to take one of our subsets and put that in via the tools that are on the BX platform, you can do that. So just to flip to the next slide, G, just to sort of summarize through, what we're really doing is we're saying, let's regularly review what stocks are out there, are giving us alpha. We rebalance our portfolios every couple of months. There's a reason for doing that, which is really to make sure that when alpha is available, it's not available forever. So we're taking points in time and we're saying, okay, alpha is available now across these 48 stocks or these 36 stocks, whatever size portfolio you may have. But we're going to regularly review whether, if that alpha has returned us our expectations, whether it's still worth holding on for another 2-month period or 4-month period. And the balance that we have there is that we put together a portfolio for you of individual stocks, which captures a risk-balanced approach to where individual ideas are available, but also recognizing that there are familiar patterns and styles, value or growth, which we're actively exposing you to each time we rebalance that portfolio. We're consciously deciding these are now trading like value stocks. We're going to own these value stocks out of all the potential ones that are out there. So in summary, just to go through the final slide, it's a portfolio concept. We're operating not just here's a good idea, but these are stocks that you can see in the portfolios. They're going to be familiar names. They're going to be stocks that it makes sense to not be holding NVIDIA at the moment, or it makes sense, yes, to be holding, keep using NVIDIA because it's on everybody's mind. But, yes, it makes positive sense to be owning some of the financials at this stage in the cycle. Oh, and actually out of those, these are the ones that are showing the best alpha at the moment. So it's a systematic approach. It's based on 20 odd years of experience of building these portfolios, and the returns that you can see both on Index One and you can see via the BX platform show you that this approach is systematic and it works. And that's really where we bring alpha to the table, is to say, let's put stocks together in a smart way, recognize that they're adding value, adding alpha, and we're putting that together as a portfolio for you.
Thanks, Chris. Thank you for that. So I will pass it on now to John. John, could you provide some insights on how advisors can develop trend capture strategies and how these strategies can complement and enhance other investment factors?
Joining us here today. Trendrating is predicated on a proprietary model that was created over the course of 4 years of testing. So we did massive amounts of testing on indicators to come up with what we felt were a subset of indicators that are going to most greatly influence price moves or price fluctuations. Just to kind of background why we went through this exercise is, over 10 years ago, fundamentals typically were more in line with price movement. And for a whole slew of reasons, mostly based on technology, that paradigm has shifted. So what we're trying to do is we're trying to complement fundamental research with our own proprietary trend capture model. By putting two of them together, we increase the probability of being able to recognize a strong trend that has quality fundamentals early in the cycle, and then unwind that position before too much profit is given back. So acknowledging price trends is the first thing that really jumped out when we started this company in 2014. Not everybody believed that there was such a concept. They thought it was just a factor of markets in general. But we've seen hundreds of firms that we service, wealth managers, financial advisors, institutional asset managers, that are now using our metrics to be able to measure the duration and the quality and the consistency of the price trend along with those fundamentals to try to capture the performance dispersion. Performance dispersion, is something that always exists in any market. So you have a cycle of different names that are going to be in favor or out of favor. The key is, and it seems obvious, but to capture the winners early and to unwind the underperformers before it's too late. So what we've done is we've built a model that is available through a technology platform, a data feed, or through model portfolios or indices, some of which are available through BX and Index One. Next slide, please. So, briefly, without going too deep into this, our model consists of multi-layers of measuring a price trend. I mentioned before, we looked at hundreds of different combinations of indicators. We decided on 8. Those 8 are updated daily with price, volume, and volatility. We have a grade scoring system, A, B, C, or D. It's not enough to be able to just qualify a trend based on a grade. So we have 3 different metrics that accompany that grade to give you a sense of the magnitude, the directional consistency, and the risk of reversal. So those 3 metrics can be used in the platform to measure existing portfolios or to create model portfolios or indices that we've done in conjunction with BX. Next slide, please. So basically, going back to my first point, there is a very big reliance on fundamentals and how effective they are. So what we have in our tool set is a way to be able to look at the effectiveness of different combinations of fundamental metrics. This varies by cap size, it varies by sector. This information is available in platforms like Bloomberg and FactSet, et cetera. Not always easy to access. So, our research team has gone to great lengths to put together dozens and dozens of different combinations to look at when growth and value resonate within a certain sector, within a certain cap size, and then to give you a point and click way to be able to click on that and either create a strategy with that, or use that to evaluate a list of stocks that you might be interested in. So we're on the next slide. G. Yeah. So, for example, you might be looking at, Chris touched upon this. There's going to be certain sectors that are in favor and out of favor. What combination of fundamentals are currently driving utilities, versus IT, and to see what the returns have been year to date, what the returns have been historically over the last 3, 5, 10 years. So we put this all into our ingredients to build our portfolios, to be able to set a standard of quality in addition to being able to capture the best trends of each subset. Next, please. So we make this available as a platform. So we do have folks that want to do this themselves. They want to go through, they want to look at all the different combinations. And then, you could just do them based on their own metric. I just want to build a value portfolio. I just want to build a growth portfolio. Let me see what it looks like when I overlay a trend validation on top of that. And typically you'll get an improved performance when you do that. And those are the indices that are available through the BX and Index One platform right now. Next, please. So to summarize, what we're doing is we're looking at a large universe, and this could be anything. It could be based on region of the world, theme, size, quality, and then we're saying, what are the best metrics within those subsectors that tend to work best? And we're also aware of which ones work worse, which we try to avoid. The next thing is sort of our edge, is to be able to put a trend validation on top of that, and then to have a list that's generated that follows a rules base that's easy to explain, and that could be generated in print form for compliance purposes. If you have any questions about this, I think our contact information is at the end, and I'd be happy to give a demonstration to anybody interested. Thank you.
Thank you so much, John. Next, I will pass it on to Alex, who will talk us through how advisors can build alpha-seeking strategies using the Index One platform.
All right, thank you, G. So for a bit of background, when we started Index One about 5 years ago, really the intent was to create a platform that allows for creation, backtesting, and management of different types of indices and investment strategies, regardless of what the purpose is. If it's to launch a passive product or use it in a SMA or license out the strategy. And that's really what we've done here and what we're working on with BX and the other partners on this call. So as we've gone over earlier, the sort of strategy providers here on this call are really responsible for research and creation of novel investment strategies or signals. Our focus is really on the infrastructure and tooling required to manage these over time and monetize these models, which is something we've been working on closely with BX. So the thing that really all of these strategies have in common as it comes to maintenance is they need to regularly rebalance, need to run reporting, we need to run adjustments based on corporate actions, so dividend splits, delistings, and other events. And publication and distribution of the strategy is an important factor as well. So that's something we have built into our platform, and we take pleasure in working with firms like ones on this call and in supporting the evolution in this space. As far as actually creating and running strategy on the platform works, it's can be fairly simple or fairly complicated, but in essence, we take in methodologies, rebalance schedules, any specifications around how the strategy is calculated, for example, base currencies or specific corporate action treatment. We can also just take in basic weighting files, and with those we run back tests and also live calculation of the index, either on a real-time basis or end-of-day basis. And we support the screenshot you can see here on screen is an example of a live strategy we're running. So you can see the performance versus benchmark. You can easily generate up-to-date fact sheets in PDF form, and also publish this information. So send it to any prospective clients or other interested parties. But in essence, whether it's fundamental based or factor based or timing based or some other type of strategy, we can support in managing and maintaining those and bringing them to market. That's from my side, I think, I need to run through, but pleasure working with everyone here, and hope to develop this further.
Thank you, Alex. Justin, we'll pass it on to you now. Could you provide an introduction to Artha and explain how it can be leveraged to develop and implement an asset allocation strategy?
Yes, and thanks, G, and thanks, Alex, for hosting today, and thanks to everyone tuning in and taking the time. So Artha is a branded asset management platform sponsored by our company, Global Beta Advisors. And the intention is really to allow users to come in, or advisors to come in for that matter, and construct asset allocation models, build their own silo strategies like you're hearing from some of our strategists here today. And it's really to streamline the model building capability and also streamline the investment process. So we want you to be able to go A to Z from constructing a strategy and executing on it, and doing it in an extremely efficient way. So I'm going to start by sharing my screen here and showing you exactly what Artha can do, particularly from a model standpoint. So we're already in the Artha application, and we're already in the model marketplace of Artha. So again, Artha is a multifaceted asset management platform, but we're going to focus specifically on our model marketplace today. And you'll notice here that many of the BX indexes, which are administered by Index One, are in our marketplace right now. And the beauty of that is that we're getting the real-time updates every day from Index One, and we also have the BX. We also have the Index One fact sheets associated with each strategy. So think of this as a grocery store, right? And you can go through and analyze every strategy a la carte, better understand what each one is intended to do, and a lot of the risk parameters around each strategy. So again, as we can see, each index is here, their descriptions are here, and as Alex was kind of demonstrating in his conversation, the fact sheets can be streamed in the application, so you can kind of get a high overview of the strategy. You can see the performance, and again, this is updated daily, and really get a sense for the strategy's tendencies. And the extra thing that we have enabled into our platform is we have an integration with nitrogen. And so by virtue of that integration, we can import the risk scores of these portfolios. So you'll see those right here. And so that allows you as the advisor, you as the user, to really be able to select and build your allocation specific to the risk objectives of your clients. So let's get into it right now and kind of show you some of the pre-canned models that we built and kind of give you an ideation around how this model building can work for you. So let's go to one of the ones that we've created here. So we've called this the Index One Aggressive Growth Model. And you can see here that we've already selected a few of the BX indexes in here. And we can see, obviously, their scores individually, but how the construction affects the risk score. So, as you can imagine, this isn't so much that we're taking a weighted average, or this isn't taking just a weighted average risk score of these portfolios, but rather it's taking into account, the correlations of the underlying assets in them as well. So this is dynamic. So if you wanted to come in here and build this model, let's go to Edit Model. You can change the weights of these models, and you can add additional models as well. So you can sort through the existing models or the existing indexes that I showed you in the marketplace, and select more of these indexes, or remove some of the existing indexes, or change the weights. So I'll go ahead and change one of the weights here to kind of give you the dynamic of how the risk score will change. So you can see that I've quickly changed the weight of these two strategies here. I brought this one down to 25, and I brought this one up to 25. And the risk score started at 86, it dropped to an 80. Of course, this makes sense because the higher risk portfolio was reduced and the lower risk portfolio was increased, thereby reducing the risk score of the overall composite model portfolio. And so, this allows you to go ahead and kind of trial and error some of the different allocation types. Our portfolio management team can assist you with building appropriate strategies specific to a risk score here, but we allow you the tools to do it on your own as well. So again, this is a great exercise to run through to build and construct your model portfolios here. Now, one thing that you may be thinking is, okay, well, if I have a model portfolio of strategies and some of them are tactical in nature, of course, the risk dynamics of that portfolio are going to change from time to time. So how do I factor in? How do I handicap the fact that there could be a fluid risk of a portfolio in my composite model portfolio? So the way that our platform is constructed is that we have a risk analyzer. So it'll alert you when your risk score falls out of line with the intended risk score that you set out to. So let's just say that you have clients with a risk score of an 86 or a risk score of an 80, right? And you've allocated this model to them. The platform will monitor that strategy, and if that if that strategy exceeds or goes below that 86, you'll receive an alert in this section here, and then you can remediate that issue. So you can see where within the model composite that the issue's persisting, and you can go ahead and remove that particular strategy from your model portfolio composite and add a more appropriate model. So for example, if you had a tactical strategy in here and you allocated a weight to it, assuming that it was a risk score of an 85, but then that tactical strategist decided to go more risk off, and so the risk went down to a 20, you would be alerted to that effect. You would go into this model portfolio, remove that tactical strategy that went from an 85 down to a 20, and add a strategy that has an 85. And so thereby, rectifying your model portfolio, and then you can seamlessly rebalance your clients accordingly. So that is a very helpful tool to stay on top of any tactical moves in some of the individual strategies that make up your model portfolio here. And you notice here that you can add cash components as well. So that'll allow you to manage cash in your clients' accounts as well. So I'll show you one more example of a model composite. So we can look at this from a conservative standpoint. And again, you can see how the dynamic has changed. We were looking at more of an aggressive. It was about an 86 down to an 80. And here we can see that we constructed the same strategies, but we've changed the weights such that you're bringing the risk score down to a more conservative level, which is a 26. And the other part is, so we're looking at this at the strategy level, right? And so we can also see how the underlying securities act as well. So this is the underlying securities on a weighted average from the models selected in the portfolio. So you can see kind of the contributing effects of the underlying securities in the portfolio as well. So that's helpful as well because it gives you a sense of what you're investing in. Maybe you're over allocated to bonds, maybe you're over allocated to growth. It just gives you some more transparency in the investing process. You can also, we also have within our application, you can actually look at performance. So as I said before, you can pull up the fact sheets from index one that are associated with a particular index. And then when you create these model portfolios, you can also see the underlying performance of that as well. So let me show you one more thing here. You can, just as much as you can build a model portfolio of different strategies, you can also associate your own model or own strategy in here as well. So this allows you to upload a list of securities that you may be holding. Let's just say that you've built a model of ETFs. You can go ahead and upload those that ETF model portfolio here and add that into the composite model portfolio as well, or you can upload it here and run it as separately as well. So let me quickly show how the performance looks in the application. So you've got different time periods that you can select. So right now we just look at 1 month, but let's take a look at year to date. You can also select a benchmark, and we can customize these benchmarks as well, but let's just take the S&P 500, and you can look at how it plots out for the year. And you can also gain appreciation for the risk characteristics of the portfolio as well. So just as much as Chris had mentioned at the top of the call, the intention is to build alpha into your portfolios. Well, here you can understand how, as you build these model portfolios, what does that look like on a risk-adjusted basis? And so that here you can discern from the risk characteristics built in the application, and you can measure it over various time periods here. And then, of course, you can go down and take a look at the trailing performance as well as the calendar year performance. So this is a helpful tool, not only to look at each index individually, but also as you build those model portfolios. Again, as indicated, we have contact information that will be relayed at the end. And if you have any questions or would like to run through a more extensive demonstration, I'm happy to do that. Thank you.
Thank you, Justin. That was very insightful. Chris, back to you. Could you share some strategies for combining alpha-seeking indices with other investment approaches?
Right. Thanks, G. So what you're looking at here is the result of a simple blend of 3 different strategies, one from each of the providers that you see listed. Keep in mind, we've got a network of about 15 different index creators who all have a different approach. They have different techniques, and they're doing it in different markets. So it enables you to build very robust and diversified portfolios. So this is just for reference. What you're looking at here is a compound return of 18%, blending 3 of these managers. That compares to 12% for the S&P 500 over the same time frame, with basically an identical standard deviation. So what does that mean? It means that is alpha that you're getting right there. These strategies, if you look at a correlation matrix between the 3 of them, there's a 0.70, a 0.75, and a 0.80. So in other words, you're getting a good diversification benefit when you take 3 strategies or any number of strategies that perform well on their own, and they have low correlation, and you combine them, you're going to wind up with better overall outcomes, because really that's what you're trying to do for the client. It's great to have the option of leveraging any one of these strategies, but any one of the strategies does not a comprehensive portfolio make. You can also blend, these are all equity managers. You can blend them with fixed income, where we also have alpha delivering managers to create really exciting portfolios. For example, when I told you at the beginning of the call that the 3-year compound return for the cap-weighted moderate blend of 60/40 was 1.3%. If you take these 3 strategies and blend them with 2 of our fixed income strategies in a 60/40 ratio, you were compounding at 10% over that same time frame, which makes a huge difference to a client. And not only that, you took your maximum drawdown from a 23 to a 12. And that's really the kind of thing that clients worry about. So if you look at we analyze a lot of portfolios for advisors that come in and say, can you take a look at what we're doing? And when you pull up a correlation matrix, so much of it is cap weighted or index hugging, and you're seeing correlations of 0.94 and 0.96. You're not getting any diversification at that level. If you pull up a full correlation matrix on a lot of our strategies, just the equities, you're seeing 0.6s, 0.7s, even sometimes as low as 0.5s, 0.8s. You can put those together and really help create the outcome that your client wants, which is better returns with, frankly, lower risk. G, you want to turn the slide? Yeah, so this is just showing you each of the managers individually, their performance, and then the portfolio as a whole. But what's interesting, back up just 1 second. If you look at that standard deviation line, you'll see the benefit of the correlations that I was talking about, because the combined portfolio has a lower standard deviation than any of the individual sleeves, which is a great outcome. In other words, if you were to pick the one that went down the least, it went down more than the blend of these three. So G, you can flip it to the next slide, and this is what I was talking about with fixed income. This is over a slightly different time frame, but you can see that the just really significant uptick in performance and downtick in risk for doing it right. By the way, what you're looking at is the output from a portfolio analysis and proposal tool that we use. We can use this to help you build what it is you're looking to do. The other nice thing about working with BX is we have 50 strategies that are made by some of these great minds that, some of which you saw showcased today. And you can blend those on your own or leverage our expertise to help you create a blend that's right for you and for your clients at various risk levels. But also, if you say, man, I really like the way that strategist thinks, but none of those sleeves is exactly right for me, we can work with you to create custom indices at certain levels. So we're really flexible. We're open architecture. We just want to provide you with a great choice of great tools to help you, frankly, to do better for your clients so everybody can win. And that's really all I have, G. So I don't know if we want to open it up for questions.
Yes, thank you, Chris. And thank you, everyone, for your insights and your contributions today on building alpha-seeking portfolios, optimizing asset allocation, and managing risk. To our audience, please feel free to submit any questions in the chat box, and we'll be more than happy to answer them for you. One question that Chris Tinker, maybe you can answer is there a reason why you rebalance your strategy every 2 months?
Yes, G, thank you for raising that point. The details of any strategy you put together, obviously the underlying assumptions become sort of embedded in process, but sometimes it helps to be able to expand on them. One of the things we're conscious of, it's probably goes to John's strategy as well. One data point is an event, more than 1 or 2 data points starts to make a trend. So therefore, when we're putting a forecast together, we realize that every stock is going to have a relatively regular update of information. It's going to be an earnings report. It's going to be an update, maybe sectorally or maybe just market rebalancing of portfolios or ETFs. There tends to be an event or maybe 2 that are going to occur. So if I have an idea that identifies alpha, if I hold that idea for too long, events will have overtaken it. The information that the forecast is based on will become stale and out of date, and I'll end up having unbalanced risks in my portfolio. You can go as far as to say that the optimal portfolio that you have on Tuesday, by Wednesday it's already suboptimal because things have happened. So it's really a trade-off between how frequently you need to reassess both the opportunities but very specifically the risks. And a lot of the analysis that I've done over the years, and I've been running these strategies for 20 odd years now, is that the time period you want to rebalance on is less than a quarter. A month is too short because events and full estimations don't tend to roll out. So a lot of the work we did in the early days of building Apollo, which is the valuation tool, used a 2-month time frame, and optimizing around that when we were putting together the back tests that we run for the the Smart Alpha portfolios, determined indeed that rebalance of 2 months makes sense. And what we do is we rebalance on the third Wednesday of every other month. So the third Wednesday in February, in April, in June, etc. We don't want to hit end month noise associated with other monthly portfolio managers. We want to avoid the impact of bank holidays, particularly in the US market, where there are a lot of public holidays on Mondays. So we want clean information to go in to our decision point on the Wednesday. So Tuesday closing prices are what we use. We want to avoid options expiries. We ideally want to avoid market distorted noise, in other words. So we balance midweek every other month on the Wednesday, and that helps both the risk management process, but also a systematic idea generation process. And that time frame is therefore something that a lot of our clients like, the idea that we are actively managing risk as well as identifying alpha opportunities over a time frame that seems to make sense for both.
Brilliant. Thank you, Chris. I believe this question could go to BX. How do you integrate your models with custodians and tech stacks?
Sorry, I realized I was on. I'd gone back to mute after I finished speaking before. We have a number of different ways that we can get integrated with custodians and tech stacks. I mean, for example, Artha is one of them. Justin actually is the CIO at Global Data Advisors, so they run portfolios that deliver alpha for us, but they also run Artha, which is a platform in one of the many different ways that we have that we can connect to different custodians. If you get in touch with us directly, we can partner with you to figure out what's the most efficient and effective way for you to get connected. But I will just say there's a number of different ways that we can do it.
Okay, brilliant. Thank you, Chris. Okay, so I don't think there's any more questions at the minute. So what I will do is give everyone watching an opportunity to reach out to the participants in today's webinar through their websites. So you can reach Alex at indexone.io. You can reach Justin at helloartha.com, Chris Tinker at libra-is.com, John Coulter at trendrating.com, and Chris McHeffey at bxindex.com. Thank you once again, all of you, for your time and participation. You can find Artha, Libra, and Trend Ratings models on the Index One and BX websites. Thank you to everyone that tuned in today. We look forward to seeing you at our next webinar. Thank you, everyone.
Thanks,
Thank
G.
you.
Thanks, G. Thanks for organizing that.